time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
CCOM satellite system, CMI and the TSX. Price about $1. Stock is down 48% in the last year. Market cap 42.2 million. Pays a dividend, about a 5% yield. What does the company do? They develop and deploy commercial-grade mobile auto deploying satellite-based technology for the delivery of two-way high-speed internet, VoIP, and video services into vehicles. CCOM has developed a unique proprietary mobile auto-deploying iNet view antenna that allows the delivery of high-speed satellite-based internet into vehicles while stationary virtually anywhere one can drive. So what has led to the share price lowering itself over the past year? Q1 fiscal year 2023 revenues dropped 77% to $683,000. The company reported a loss before other income and income tax of approximately $448,000 compared to operating income of $802,000 in the same quarter of 2022. So management has stated that demand for the company's product is sluggish in the face of a number of headwinds, including economic uncertainty due to the war in the Ukraine, inability to sell products due to the embargo, supply chain issues with availability of products customers are requesting to be integrated with the company's antennas, component shortages, and fear of global recession. These factors are all having negative effect on CCOM and its lower than usual revenues for the first quarter. So our take. The positives here include a very strong balance sheet for a business of this size. The company completed Q1 fiscal 2023 with $17.36 million of cash and marketable securities. Basically no debt. That's 42% of the company's market cap. The cash allows the company to remain committed to its R&D program despite these near-term headwinds, as new products are essential for long-term success, including the company's recently announced recently announced that it had received formal qualification for its iNet View series antennas from Intelsat. Intelsat is one of the world's largest integrated satellite and terrestrial network operators and a leading provider of in-flight connectivity. But it takes more than just cash on the balance sheet to meet our criteria. While the dividend appears attractive and the company has cash on hand to continue paying it, we note that operating income has only covered the dividend in 3 of the last 9 quarters. It is true that there is lumpiness to the business, but this is not a sustainable long-term approach. Business will have to recover to more normalized levels to make a dividend make sense long-term. While the existing technology, cash on hand, and new developments may ultimately be worth more than the current share price, without current strong cash flow and facing near-term continued headwinds, we are not currently recommending a buy on CCOM at present. We will revisit it in the future as the macro environment improves for the business.
I've always, the idea of paying your dividend with cash in the bank, I mean, it doesn't really make a lot of sense to me. I suppose if you have too much cash and you need to get rid of it in the form of a special dividend to return it back to shareholders, I can understand that. But the whole idea of a regular dividend is that it's supported by underlying cash flow, right? I mean, I want to know that that's sustainable. I want to know that that dividend can grow. And, you know, as you know, I mean, CCOM, it's had issues maintaining profitability and maintaining consistency of financial performance in the past. So nice balance sheet, but
it's lumpy, and you know, in the current environment, it wouldn't be something. You know, we had recommended the company years ago when it had about around 50% of its cash in the bank. It had been profitable for a number of years. It was trading at 40 cents then, and then ended up exiting about $1. You know, the business, at some point, maybe it's an acquisition target, but we don't buy businesses just based on that. Like Aaron said, without sustained profitability, it's just not a company we would recommend right now. There may be an opportunity at some point if you saw a long-term trajectory ahead of them for growth over a 3, 4, 5-year period. Don't see it right now. And while there is that great cash stockpile, if they're not creating cash over time that gets depleted, and it's not a business that would meet our criteria.